Let's be honest, the way we all think about the cloud is just wrong. And in the world we live in today, that mistake, well, it could be a very costly one. We are not just talking about software anymore. This is a new industrial arms race. So let's break down exactly what that means and how you navigate it.
You know, we've all been conditioned to think of the cloud as this, this magical, intangible place where our data just floats. But that's not just a misconception, it's a dangerous one. Because the truth is, the cloud is made of millions of physical servers. They're housed in these massive, power-hungry buildings located in very real, very specific places on a map. It has a street address.
And that question? Well, it's not a what-if anymore. Just recently, Amazon Web Services data centers in the UAE and Bahrain were actually struck by unidentified objects. In that moment, the abstract idea of the cloud collided with the brutal kinetic reality of modern warfare. And that, my friends, changes everything.
So this is it. This is the new reality. We have this massive, unprecedented build-out of AI infrastructure happening at the exact same time that physical conflicts are escalating around the world. All of a sudden, the digital moats that big tech built are being tested by actual missiles. This is the new battleground.
And that brings us to a concept that is absolutely critical right now: sovereign physical survivability. The rules of the game have completely changed. It's no longer just about who has the best code or the slickest app. Now it's about who can physically build, power, and, most importantly, defend the infrastructure that our entire digital world runs on.
This slide just captures the shift perfectly. On the left, you've got the old world, right? Capital light software, where the biggest drama was a user interface update. But on the right, you have today's reality, a capital-intensive industrial arms race. And you don't have to look any further than Jeff Bezos. He's not just focused on software. He is putting together a $100 billion vehicle to revolutionize physical manufacturing. He's betting on the factory floor. So, the big question is, how do you invest in this new world? Well, let's put some money where my mouth is. I don't just talk about the markets, I take positions within them. So here it is, the actual portfolio built around this very thesis.
All right, here's the whole shebang. 10 core positions. You've got the giants, of course, Amazon and Google, but they're sitting right alongside specialists like Kratos, we're going to talk a lot more about them in a minute, and Western Digital. But honestly, the most interesting thing about this portfolio isn't just the names on a list, it's the tension between them.
The total adjusted value is sitting at just over $400,000. But the real story isn't in that total number. It's in the opposing forces at work inside the portfolio.
Right now, this portfolio is paying what I like to call a psychological tax. On one side, you have Western Digital, which has been an absolute monster, a 330% winner. And on the other side, you've got positions like FINTECH or TIGR, which are bleeding, down about 30%. This is the reality of the market, and the biggest test of our conviction at this very moment is Amazon.
Okay, let's talk about Amazon, because right now, the company is a perfect case study in two of the most common investor biases out there: recency bias, where we fixate on recent events, and loss aversion, our tendency to fear losses way more than we value gains. The retail crowd is fleeing, and it's all because of one huge number. $200 billion. That's what the company said it's going to spend on capital expenditures in 2026. That's a 53% jump from 2025, and it has caused absolute panic. The fear is that their free cash flow could actually go negative for the first time since 2022.
And this is what that fear looks like: an unrealized loss of over $11,000. The market clearly hates this news. But the most important question isn't what the market thinks, it's why it thinks that, and why it might be completely missing the point.
So the crowd is panicking because they see CapEx as just spending. It's that loss aversion kicking in. They're fixated on the immediate paper loss. They see negative cash flow and they get spooked by the ghost of 2022. But the architect's logic is totally different. We don't see spending, we see infrastructure capture. We see a $244 billion AWS backlog, which is up 40% year over year. We see AWS revenue accelerating to 24% growth. That's the fastest it's been in 13 quarters.
And if you need one number, just one, to justify that massive $200 billion investment, this is it. OpenAI has committed to spending $100 billion on AWS over the next 8 years. See, Amazon isn't just spending money, they are building the actual physical foundation for the entire AI revolution. They are making themselves indispensable.
So while Amazon is fighting that perception battle, let's look at a company that's already winning on the physical battlefield: Kratos. This is the other side of our thesis, and it is playing out perfectly. Kratos is what you'd call a disruptive change agent. Their entire strategy is built around this concept of affordable mass. They don't build these $100 million exotic systems. No, they build huge quantities of low-cost, autonomous combat aircraft. Think of them as loyal wingmen that fly alongside our manned jets.
And yes, I know what you're thinking. It's trading at a very, very high multiple, 120 times earnings. But that's the price you pay for owning the undisputed leader of a military paradigm shift. When their Valkyrie drone was selected as a program of record for the U.S. Marines, that was a generational win that proved their entire business model works. And the tailwinds behind them are just enormous. You've got the official program adoption, a potential $1.5 trillion military budget coming down the pike, a massive expansion of their manufacturing facilities, and 75% institutional ownership. The smart money is already here in a big way.
But look, no strategy is risk-free. If we're going to be intellectually honest, we have to look at the potential headwinds and the things that could actually derail this entire thesis.
The biggest risk factor is geopolitical, and we can just call it the Trump variable. For defense companies, there's this threat of a profitability ceiling if dividends get blocked. For Amazon, the risk is CapEx fatigue. I mean, what if that huge AI spending spree doesn't pay off? And for our TIGR position, yeah, the threat of a tariff war is very, very real.
Which brings us to a tough question I have to ask myself. Is holding on to this TIGR position, which is basically a bet against geopolitical madness, just revenge trading? Am I holding on to it simply because I'm blinded by that 30% drop? It's a fair challenge.
So, what's the plan? What's the next move? First, we hold our Amazon position. That $200 billion spend is the price of admission to the future, period. Second, we're going to trim our winner, sell about 10% of Western Digital to lock in some of those fantastic gains. And third, we're going to build up our cash cushion, get that capital ready to buy more Amazon if the market panics and gives us an even better price.
So the most important takeaway is this: the mental model of the cloud has to change. It's not about apps and software anymore. In this new era, you have to think of the cloud as a physical, defensible, and absolutely essential fortress. And the people building the walls, they're the ones who are going to win.